Something strange is happening in the markets right now, and most retail investors are completely missing it. The same Wall Street institutions that are publicly calling quantum computing stocks overvalued, the same analysts writing research notes comparing this sector to the dot-com bubble, the same banks issuing cautionary warnings about unsustainable price-to-sales ratios. Those exact same institutions are quietly building positions in quantum computing behind closed doors, not through the pure play stocks that retail traders are piling into, through something far more calculated, far more strategic, and far more revealing about what the smart money actually believes about the future of this technology. And the most unsettling part is not that they are buying. The most unsettling part is the word quietly, because when Wall Street moves quietly, it almost always means someone knows something that the rest of the market does not. To understand what is happening, you need to understand the landscape that existed before 2025, because the speed and scale of what has changed is almost impossible to appreciate without that context. For most of the previous decade, quantum computing occupied a peculiar position in the technology world. Every serious physicist and computer scientist acknowledged it as a potentially transformative technology, but the timeline to practical commercial utility was universally quoted as somewhere between 10 and 30 years away. The phrase quantum computing is 5 years away became a running joke in the industry, a line that seemed to reset itself every 5 years without ever arriving. Venture capital invested in the space, but cautiously. Institutional investors largely ignored the pure play companies, and the public markets reflected that skepticism, with quantum stocks trading at modest valuations relative to what would come later. Then December 2024 happened. Google announced the Willow chip, and the entire psychology of the market shifted overnight. Google's Willow processor did something that no quantum computer had convincingly done before. It demonstrated that adding more qubits to a quantum system could actually reduce errors rather than increase them. This breakthrough, known as going below threshold, had been the holy grail of quantum error correction since physicist Peter Schier introduced the mathematical framework for it back in 1995. Every previous quantum computer had hit the same wall. The more qubits you added, the more noise accumulated, until the whole computation fell apart. Willow broke that wall, and the benchmark performance numbers that came with it were staggering. The same calculation that would take the fastest classical supercomputer on Earth approximately 10 septillion years, a number so large it dwarfs the entire age of the universe by factors that are difficult to even comprehend. Willow finished in under 5 minutes. Like and subscribe. That is not a marginal improvement. That is a civilizational inflection point, at least in terms of what the research suggests is theoretically possible if the architecture continues to scale. The market reacted the way markets always react when a technological narrative crystallizes around a believable timeline. Money flooded in. IonQ, a quantum computing company that uses trapped ion technology rather than superconducting circuits, saw its stock surge by more than 700% over the following 12 months. Rigetti Computing, which focuses on superconducting qubits and multi-chip quantum processor architectures, at one point delivered trailing 12-month gains that approached an almost unbelievable 5,400%. D-Wave Quantum, the oldest publicly traded quantum company whose annealing-based approach is fundamentally different from gate-based systems, surged over 1,500%. Quantum Computing Inc., a company working with integrated photonics, raised over $1.5 billion in institutional capital through a series of oversubscribed private placements in the fall of 2025, with one offering alone bringing in $750 million from institutional investors. These are not retail trading numbers. Institutional money was showing up. The Defiance Quantum ETF, which tracks a basket of companies across the quantum computing and machine learning space, returned 37% in 2025 and 50% in 2024, figures that handily outpaced the Nasdaq 100, itself a strong performer during both years. The quantum market had gone from a long-term research curiosity to the hottest sector on Wall Street, and for a brief, intoxicating period in mid-2025, Quantum stocks were posting the kind of gains that AI stocks had posted in 2023. It looked from the outside like the early innings of the next great technology supercycle, and then the serious warning signs started appearing: like and subscribe. The first and most damning signal came from the people who know these companies best. The insiders. Form for filings with the Securities and Exchange Commission are required whenever a company's high-ranking executives or board members buy or sell their own stock. They must file within 2 business days of any transaction. These filings are public, freely searchable, and widely followed by professional investors as one of the most reliable signals of management sentiment about a company's near-term trajectory, because there is only one rational reason for. An insider too shares the expectation that the stock will go higher, and the list of reasons to sell is far longer and more varied. What those filings showed about IonQ, Rigetti Computing, and D-Wave Quantum was deeply uncomfortable. Over the 5 years leading up to mid-2025, insiders at those 3 companies had collectively sold approximately $931 million more in stock than they purchased. $931 million in net selling by the executives who attend every strategy meeting, who review every technical roadmap, who know exactly how far the hardware is from commercial deployment. That number is a message, and the message is not encouraging for people holding these stocks at peak valuations. The valuation numbers themselves are equally alarming if you approach them without the filter of narrative. Rigetti Computing at one point in 2025 traded at over 1,000 times its trailing 12-month sales. 1,000 times sales. To put that number in perspective, Palantir Technologies, a company that Wall Street regularly cites as an example of excessive valuation, trades around 120 times sales. Rigetti was 10 times more expensive than what many consider the most overvalued large-cap stock in the S&P 500, D-Wave. Quantum traded at over 300 times sales. IonQ, the most conservative of the pure-play names by this measure, still sat at around 145 times sales. These are not valuations that reflect a company's current business. These are valuations that price in a future that, by most technical assessments, is still many years from arriving. Historical precedent here is not kind. Before the dot-com bubble burst in March 2000, the most hyped companies in that cycle, Microsoft, Amazon, Cisco, eBay, peaked at price-to-sales ratios in the range of 30 to 144. No company with a P or S ratio above 30 sustained that valuation for an extended period. Every hyped technology cycle in the last 30 years, without exception, has required an early innings bubble bursting correction before the real adoption curve could begin. The internet was real. E-commerce was real. The bubble burst anyway, and the companies that survived came out the other side building real businesses at rational valuations. The technology matured on a timeline that took 15 years longer than the peak hype suggested. Quantum computing has all the hallmarks of being in exactly that same position right now. Like and subscribe. But here is where the story gets complicated, and this is the part that the bearish case almost always leaves out, because the bearish case is built around pure play company valuations and ignores what is happening at the institutional and governmental layer beneath the headlines. Because while retail investors were piling into Rigetti and D-Wave at 1,000 times sales valuations, something categorically different was happening among the institutions that actually set the trajectory of strategic industries. J.P. Morgan Chase had a quantum research team actively running experiments on quantum hardware, exploring portfolio optimization, risk modeling, and derivatives pricing algorithms. Goldman Sachs was doing the same, though it would later scale back those efforts after finding that current hardware was not yet reliable enough for production deployment, a fact that is itself revealing about the state of the technology. BlackRock and Vanguard were building internal quantum expertise and establishing vendor relationships with quantum technology providers. CBC and IBM announced in September 2025 what may be the most commercially significant quantum result in the financial sector to date. Empirical evidence that a quantum processor used in a hybrid workflow alongside classical computing could improve the prediction of corporate bond trade fills by 34% compared with standard classical methods. That is not a theoretical result. That is a measured improvement on a real financial task using real market data. BNP Paribas was running collateral optimization and derivatives pricing experiments with a neutral atom quantum computer from a French company called Pascal. These are not the actions of institutions that believe quantum computing is pure hype. These are the actions of institutions that believe quantum computing is coming and that the firms that establish expertise and relationships now will have a structural competitive advantage over those that wait. In finance, being first to a new computational capability is worth an enormous amount. If your optimization algorithms are 30% better than your competitors, or your risk models are faster, or your arbitrage detection is running on quantum accelerated hardware, those advantages compound over time. The institution's building. Quantum. Expertise in 2025 and 2026 are not doing it because they expect quantum computers to replace classical systems tomorrow. They are doing it because they expect the transition to be gradual, technically complex, and strategically decisive for whoever positions themselves correctly. Then came the event that changed the financial framing of this entire sector in a single day. On May 21, 2026, the United States Department of Commerce announced the signing of 9 letters of intent to distribute $2 billion in federal incentives under the CHIPS and Science Act specifically to quantum computing companies. Like and subscribe. IBM received $1 billion, the largest single allocation, to establish a new subsidiary called Andron, which will build the first dedicated quantum wafer foundry in the United States, manufacturing 300mm quantum-grade superconducting wafers. Global Foundries received $375 million to launch a quantum manufacturing division capable of working across multiple quantum modalities, including superconducting, trapped-in, photonic, and silicon spin architectures, D-Wave quantum, Rigetti computing, inflection, sequantum, quantinum, atom computing, and a startup called Dirac. Each received up to $100 million for specific engineering challenges. And critically, the Department of Commerce took minority equity stakes in each recipient company, meaning the United States government is now a direct financial stakeholder in the success of the American quantum computing industry. IBM shares gained 12% on the day the announcement dropped. D-Wave added 33%, Rigetti soared 30%, even INQ, which was notably absent from the grant list reportedly because the company, sitting on $3.1 billion in cash and in the process of acquiring its own semiconductor foundry through Skywater Technology for $1.8 billion, simply did not need it, gained 12% just on the broader positive sentiment the announcement created for the sector. The signal this sent to institutional investors was unambiguous. When a government starts building purpose-built quantum fabrication facilities rather than research grants, it is not asking whether the technology works. It is preparing to manufacture it at scale. For investors, the relevant question shifted in that moment from whether quantum computing is real to who wins when it is. The $2 billion in CHIPS Act funds also needs to be contextualized against the global quantum investment landscape. The Quantum Economic Development Consortium estimated total cumulative global public quantum funding at $56.7 billion as of 2026, with $12.7 billion added in the previous year alone. China's quantum investment is difficult to verify but estimated at $15 billion or more. Japan committed $7.4 billion. The United Kingdom's quantum program has now exceeded $6 billion. France has committed nearly 2 billion euros. South Korea announced the equivalent of approximately $2.2 billion. The race is not happening in one laboratory or one country. It is happening everywhere simultaneously, with geopolitical stakes that extend far beyond any single company's stock price. Understanding those geopolitical stakes is what separates the Wall Street institutions buying quantum exposure from the retail traders buying quantum stocks on momentum. The nation that achieves commercially viable quantum computing at scale first does not just win a technology race, it potentially gains the ability to break the encryption protecting every other nation's most sensitive communications, financial systems, and military intelligence. It gains an optimization advantage in logistics, financial modeling, and drug discovery that compounds over decades. It controls the supply chain for a technology that every advanced economy on Earth will eventually need. These are not technology bets. These are national security bets, and national security bets have a fundamentally different risk profile than speculative technology investments because governments will spend whatever it takes to win them. This is the context in which the quiet institutional buying makes complete sense. Like and subscribe. The institutions that are building quantum positions are not buying Rigetti at 1,000 times sales because they believe Rigetti will generate $1,000 in earnings for every dollar of revenue. It reports this year they are building positions in companies and indices that provide exposure to a technology whose strategic importance guarantees enormous government and corporate investment for the foreseeable future, regardless of near-term commercial viability. They are hedging. They are positioning, and they are doing it before the moment when quantum advantage moves from being demonstrable in controlled experiments to being commercially deployable, because at that moment the valuation of today's pure play stocks will look either prescient or absurd, and the institutions want to be on the right side of that distinction. There is also a divergence happening within the institutional quantum story that is worth paying close attention to because it reveals something important about the maturity of smart money thinking in this space. Goldman Sachs and J.P. Morgan Chase, two of the most sophisticated financial institutions on Earth, have taken sharply different approaches. Goldman scaled back its quantum efforts after finding practical applications unattainable with current hardware. J.P. Morgan continued heavy investment and research. Both conclusions are rational given the same evidence because they reflect different time horizons and risk tolerances. Goldman's trading desk runs on quarterly results and near-term competitive advantage. J.P. Morgan's quantum research team is building infrastructure for a decade from now. Neither institution is being naive. They are making different bets on the same timeline. For a retail investor trying to navigate this landscape, the gap between the two institutions' decisions is itself the most useful information available. Current quantum hardware is genuinely not yet ready for most commercial production deployments. Goldman Sachs tested this and pulled back. J.P. Morgan believes the foundation they build now will pay off when the hardware catches up. Both are correct for their respective strategies. What this means for individual investors is that the pure play quantum stocks represent a bet on a specific timeline, and that timeline is the single variable that no one can predict with certainty. If commercially viable, fault-tolerant quantum computers arrive in 5 years, the current prices of the leading pure play names may prove to have been cheap entry points. If they arrive in 15 years, those same stocks will almost certainly go through one or more severe drawdown cycles, potentially losing 70, 80, or 90% of peak value before recovering, just as internet stocks did between 2000 and 2002, before eventually producing generational returns for those who held through the collapse. Like and subscribe. The insider selling data is the most direct window into which timeline the people running these companies believe in, and $131 million in net insider selling over 5 years during a period when stock prices rose thousands of percent suggests that the executives who know these roadmaps best are not betting their own money on the faster timeline. They are monetizing the narrative at peak prices and letting the institutional and retail buyers absorb the risk. That is not fraud, that is legal. It is disclosed publicly in every form for filing. But it is a signal that deserves to be weighted very seriously by anyone considering buying these names at current valuations. The quantum computing market will be real. Boston Consulting Group estimates it will generate up to $850 billion in global economic value by 2040. The Quantum Economic Development Consortium projects global market revenue growing at 30% annually through 2028. The sector will produce enormous winners, but the Technology cycles of the past 30 years have demonstrated with remarkable consistency that the companies that win over the long arc are almost never the ones that peak at the highest valuations during the hype phase. Amazon survived the dot-com bubble and became the defining e-commerce company, but the investors who bought Amazon at the peak of the bubble in 1999 waited 15 years to break even. The technology was transformative. The investment timing was brutal. The smart money that is quietly buying quantum exposure right now is not buying the peak valuation pure play stocks. They are buying IBM, which has the deepest quantum research program, the clearest hardware roadmap, the federal government's largest quantum grant, and revenue diversification that insulates it from any single technical setback. They are buying Alphabet, which owns Google's Willow program, has $98.5 billion in cash on its balance sheet, and whose quantum AI division produced the most consequential quantum hardware breakthrough in decades. They are buying NVIDIA, which is positioning itself as the classical computing layer in hybrid quantum classical architectures, just as it positioned itself as the GPU layer for AI. They are buying quantum ETFs that provide diversified exposure without requiring anyone to bet on which specific hardware architecture wins. They are building expertise rather than chasing price. Like and subscribe. The crash that the title of this video references is not hypothetical. The mathematical case for a significant correction in pure play quantum stocks is well established, well documented, and well understood by every serious financial analyst covering the sector. The only question is timing, and timing is the variable that has historically humiliated the most confident forecasters on both sides. What is not in question is that the gap between the current valuations of companies like Rigetti and D-Wave and the near-term commercial reality of what quantum computers can actually do for paying enterprise customers is enormous. That gap gets closed one of two ways. The technology accelerates faster than expected, or the stocks correct. Historically, these gaps close through a combination of both a partial technical acceleration that justifies a much lower valuation after a painful correction that wipes out the pure speculation premium. The institutional money buying quantum exposure knows all of this. They are not buying blind. They are buying strategically in the companies and structures that carry the best long-term risk-reward ratio, and they are positioning before the moment when quantum advantage becomes commercially undeniable, because at that moment, the entry prices available today will look very different than they do right now. The quiet part is intentional. The loud version of this trade already happened, and anyone who bought Rigetti at the peak already got the loud version. The quiet version is what happens after the correction, when the true believers and the patient capital step in, and the noise traders have already moved on to the next narrative. The crash may come, the technology will survive it, and the question for every investor watching this is not whether to believe in quantum computing. The question is whether you are positioning yourself like the institutions building quantum expertise quietly in the background, or like the retail traders chasing momentum at peak valuation, because on Wall Street those two groups rarely end up in the same place, and the word quietly tells you everything you need to know about which group currently has the better information.